It all started as a joke, people posting memes online and calling each other autistic. However, it grew to become something much bigger than they ever imagined, something that completely changed the way the financial markets work. My name is Michael Wang, and in today's video, I'll be talking about updates on the GameStop situation, continuing from my previous video. If you don't know what this entire situation is about, go check out my previous video where I explain everything digestible enough even for a 5-year-old. Before we get into today's video, don't forget to drop a like and subscribe for more quality content. Last time I covered this, the stock was trading at $243 pre-market. A lot of things have happened since then, so let's take a look at everything one by one. I'll try to make my stance on this issue as neutral as possible. At one point, the stock's price soared close to $500 pre-market, with Citron Research allegedly announcing a 100% loss and Melvin Capital announcing a 30% loss. But users on Wallstreetbets are skeptical that these companies actually closed their positions and took the losses. Their argument is that these hedge funds are using the media into tricking retail investors that they're out of their short positions so that retail investors would stop pumping the stock's price. The truth is yet to be disclosed. Chamath Palihapitiya went on CNBC to discuss the issue and made some good points. I recommend that you watch the entire interview, but let me summarize what he said. He basically said that there was a systematic unfairness that allowed these hedge funds to go short on a stock with high leverage, and that it was a smart move for retail investors to spot an opportunity with that. The focus of the matter shouldn't be on the stock's price pumping endlessly. There's nothing wrong with that because it's a free market. What we should focus on instead is how these hedge funds were able to wield massive influence over the market and how we let them get away with it all these years. Elon Musk also tweeted this, asking how shorting could be reasonable in the first place. He said, "You can't sell a house or a car that you don't own, but you can sell shares that you don't own." And while I am a big fan of Elon and understand his hatred towards short sellers, shorting actually does serve a legitimate purpose in the financial markets. Shorting can prevent bubbles from forming and can help investors stay away from companies that have been valued way over their fair value. A prime example of a successful short is Luckin Coffee. Luckin Coffee is a Chinese company that was set to become the next Starbucks, except they got caught with fraudulent accounting. A hedge fund by the name of Muddy Waters shorted the stock and publicly exposed the company's fraudulent operations. Eventually, Muddy Waters made a massive profit by betting against a fraudulent company, and while this was for their own benefit, it also provided value to the entire market as it prevented other people from investing in a shady company. To me, this is the epitome of capitalism. Adam Smith, the father of economics, said it is not from the benevolence of the butcher or the baker that we expect our dinner, but from their regard to their own self-interest. So shorting itself isn't that bad, but what was bad about the short sellers in this case? There are two reasons why. First of all, the short interest for GameStop's stock was over 100% and reached 140% at one point. This means that more stocks were shorted than the number of stocks floating. Let that sink in. Do you understand what that means? That means that if there were 100 GameStop shares in the market, these hedge funds shorted 140 shares. More shares were shorted than the number of shares that existed in the market for sale. How the hell does that even happen? There are two ways in which this could happen: the illegal way and the legal way. This can be possible in an illegal way through a concept called naked shorting. So normally when you're shorting, you borrow shares from someone else so that you can sell them, right? With naked shorts, you're short selling shares that haven't been affirmatively determined to exist. So essentially, you're shorting a stock without having to actually borrow them. And by naked shorting, hedge funds are able to put short pressure on a stock that may be larger than the tradable shares in the market. This practice has been deemed illegal since 2008. Short interest can exceed 100% in a legal way as well. For instance, take the example of a market where there's only one share of a company and 5 participants in the market. These participants are A, B, C, D, and E. Suppose that A first buys the share. He then lends it to B, who wants to short it. B borrows the share from A and tries to short it. At this point, the short interest is 100%. But for him to actually short the stock, he needs to sell it to another market participant who is willing to purchase the stock for him. Let's say that C buys the stock that B shorts. Then D comes in and decides that he wants to short as well. So he borrows the stock from C and shorts it by selling it to E. Now, the short interest is 200% because there's only one share in the market, but both B and D have a short position on it. Short interest can exceed 100% in a completely legal way. For those of you who took Macroeconomics 101 in college, this is sort of like how the money multiplier works. While there are no confirmations yet about whether hedge funds took illegal measures to heavily short the stock, the short interest exceeding 100% is surely something that caught the eye of Redditors. The second reason why this short in particular was bad is because of how hedge funds advertise their short positions to induce fear from the general public. This is what hedge funds normally do when they take a huge short position. For instance, Bill Ackman, the CEO of Pershing Square Capital, once took a huge short position on Herbalife and was very, very openly critical about the company. And while he did eventually come out with losses from this trade, there was a point where the stock's price plummeted due to investors selling the stock based on what Ackman said. With GameStop, Citron was also very open about their short position. What really pissed off a lot of people, though, was how pretentious they were about their short. They talked as if they knew much more than retail investors, and that retail investors were idiots to be buying the stock at $40. Little did they know. These hedge funds could have just taken their losses and walked home, but they didn't. Instead, there are allegations that they tried to rig the game. On January 28, Robinhood banned its users from buying GME stocks, along with other stocks like BlackBerry and AMC Entertainment. These stocks were all heavily shorted by institutions, which means that a short squeeze could cause the prices of these stocks to soar like GameStop. In case you don't know what a short squeeze is, here's a 30-second crash course. So remember, when you're short, you're essentially selling high first and then buying low. Well, you only buy low if the short is successful. If the stock's price actually moves contrary to your anticipated direction and higher than the price you sold it for, you'll eventually have to exit your position, meaning that you need to purchase the stocks at a higher price. And when short sellers are forced to exit their position because the price rises rapidly and significantly, it's called a short squeeze. This is what we witnessed with Tesla at one point as well. After the retail investors on Wallstreetbets successfully drove GME prices upwards, they were also looking to buy shares of other stocks that were heavily shorted by hedge funds, which happened to be BlackBerry and AMC. But they couldn't buy these stocks because Robinhood banned them from doing so. As a result, GameStop's price dropped from $469 to $132 and was completely obliterated by hedge funds, while retail investors had their hands tied, incapable of buying more shares. The platform only allowed them to sell. Think about it. This is like boxing Floyd Mayweather with your hands tied behind your back. At this point, you might be wondering, why the hell would Robinhood do that? Here's one perspective on why Robinhood blocked retail investors from buying GME. Remember Melvin Capital that went insolvent from shorting GME? That company is owned by a larger firm called Citadel. Yes, the company that bailed Melvin Capital out with a $3 billion investment. Turns out, Citadel is Robinhood's biggest client, responsible for 40% of the company's revenue. Robinhood doesn't take fees from retail investors. Their business model is based on gathering as many retail investors as possible by offering zero fees and allowing people to buy fractions of a stock, and allowing them to trade large option contracts with high leverage. Instead, they operate as the Facebook of finance because they sell data they collect from retail investors. So if you trade on Robinhood, they sell information about your trades to these institutions, which is far more lucrative than collecting fees. Congresswoman Alexandria Ocasio-Cortez also shed light on the Robinhood issue, deeming the situation quote-unquote unacceptable. She said that she'd support a hearing as a member of the Financial Services Committee. And the Congress has asked the U.S. Justice Department to investigate Robinhood and Citadel. Another perspective on why Robinhood blocked retail investors from buying is because they were simply short on cash. So when you buy a stock, it seems as though you immediately own the stock, but behind the scenes, a lot of steps are taken. This is a flowchart of the process in which a retail investor buys a stock and places it under his name. While it may seem like Robinhood takes care of everything, it actually only plays a very small role within the larger picture. So buying a stock and placing it under your name actually takes 2 days after you press the buy button. Before the final steps, there's an entity called a DTC, or the Depository Trust Company, that asks the brokers for a deposit. They ask for a deposit because they never know what's going to happen within the 2 days of the stock being processed. The value of the deposit they ask for increases if the stock being purchased is highly volatile. And with GameStop's volatility, Robinhood was required to pay a huge deposit to the DTC, which it wasn't able to. Hence, they got rid of the buy button. While there is an overflow of memes online about this situation, I don't necessarily think that's bad because it gets more people to pay attention to the issue. If it does turn out that there was a connection between Citadel and Robinhood, or that certain hedge funds happen illegally naked shorting, the fundamental problem about this issue will be about financial institutions manipulating the fair rules of the game of capitalism, and it won't be the first time that they did so. Back in 2008, big banks came up with a bunch of financial derivatives that most people to this day don't understand. Their intentions were fueled by greed, and when the global economy collapsed as a result, individuals were blamed. The hardworking people who had no idea what was going on behind the scenes were blamed. In the banks, no one went to jail. They were all bailed out by the government, and bankers were left to enjoy their champagne. Quite literally. This generation of retail investors are completely different. They refused to let this slide, and they found their own ways to retaliate through a collective effort. With billionaires and politicians supporting their cause, retail traders have successfully shed light on this issue. GameStop's momentum for the short term may be over, but the fundamental issue behind all this noise is yet to be resolved. What do you think? Will retail investors get the justice they deserve once and for all? Or will hedge funds find a way out and pop champagne bottles at the end of the day? Let me know what you think in the comment section below. If you have any questions, leave a comment below as well. If you enjoyed this video or found it to be helpful, please don't forget to smash the like button, subscribe for more quality content, and I'll see you guys in the next video.